So Alia Hemena, please like, please comment, please subscribe. I would truly appreciate it. I'm working really hard to make sure that you guys have the best information available to you, and I'm looking forward to your success. And please let me know what you think about the information that I've been providing thus far. So let's talk about personal investing strategies. The most common way that people start their investing journey are through what we call mutual funds. Now, mutual funds are very popular, and it's usually offered by institutions like World Financial Group, Primerica, and institutions like the bank. Now, I'll be honest with you. Growing up, we really and truly taught that we cannot manage our own money and we should always be reliant on the banks. Now, after all the research that I've done, I firmly disagree with that. And the reason is because these institutions, their number one priority is not you, the client, is their shareholders. So they're trying to make money in order for their shareholders and their investors to gain the benefit. And a lot of the times they make it sound as though we cannot manage our own money. However, the way I look at it is, if I work very hard for my hard-earned money, I just don't trust any and everybody with investing my money. I trust myself more than anyone else. And I'll explain why. Now, this is the reason I'm a big advocate on do-it-yourself investing. And this is where you could select whichever ETFs or whichever stocks fit your goals. In order for you to start your do-it-yourself investing journey, you have to pick a platform. Here in Canada, the most popular ones are Wealthsimple, Questrade, Interactive Brokers, and you could typically do that through your own banks also. Now, if you live somewhere else in the world, you have to do a little bit more research to figure out which platform is available to you and which one suits your best interests. But let's take a look at the advantages and disadvantages of mutual funds. With mutual funds, the advantages is you get professional management, automatic investment plans, and the ease of use. So essentially, they're going to sell it to you as, hey, if you come with us and you give us your money, we put it in this mutual fund, and you don't have to worry about a thing. However, here's the issue. A lot of these professional managers, I'm not saying all, but a lot of these professional managers, they basically get trained to learn how to sell you a product. And really and truly, when you start digging deeper and deeper, you realize that a lot of the ETFs or stocks that I've shown to you are a lot better options than mutual funds. Now, I'm not saying all mutual funds are bad. However, you need to do a lot of research to figure out which one will be best for you. And here are some disadvantages. There are high fees. A lot of the time, a lot of mutual funds require a specific amount of money for you to get started investing in that mutual fund. And there is lack of control. Now, the fees portion is the most critical part because that's the main reason why I don't like mutual funds. And we'll take a look at that soon. However, over a long period of time, if you're continuously investing in mutual funds, you will see that fees eat away from your total return that you could potentially get. And with lack of control, you notice that if you decide or if you found information that you want to take advantage of, with a mutual fund, there's no flexibility. You have to stick with whatever funds is in that mutual fund. Advantages of ETFs. We have lower fees, we have intraday buying and selling, and diversification. So for intraday buying and selling, understand if you purchase a share and it goes up at X amount % and you are happy with it, as long as the market's open, you could sell and you could receive your profit. And like we said previously, ETFs give you diversification, whether it's if you're in an ETF with the S&P 500 or if you're within a specific sector, you can find an ETF that gives you exposure to a large amount of companies. The disadvantages of ETFs. There is less changes to daily investments, meaning the fund managers who own the ETFs, most of them typically do passive trading, means they're only buying and selling stocks very rarely. So if you're somebody who is looking to buy and sell in a short period of time, be mindful, you are not an investor, you are a trader. So if you're looking to be a trader and to make profit in a short space of time, ETFs may not be the best option for you. You are responsible for automating your purchases. Now, to me, in 2024, this is not too much of an advantage because you can now set up, at least for most platforms, you can have it automated where the money is directly transferred from your bank account to your brokerage account, and you could set it up where you can have ongoing investment planning. So you could say, hey, I want to buy this ETF on the first of every month and keep it going. Now, not all platforms offer that option, but in today's world, a lot do. So the only tough part about the ETF investments, you just have to set up your automated purchases and you're good to go. And then lastly, a lot of brokerages charge commissions. So let's just say, for instance, you want to buy an ETF. Some brokerages charge you to buy it and some will charge you to sell it. But for instance, Plushed is a platform that allows you to buy US ETFs for free. However, you do have to pay $5 to $10 in order to sell it. So you have to do a little bit more research on the different platforms based on your investing strategy, because it depends on what you want to buy. You may find that, hey, this platform may suit me better than this next one. So remember when I said that mutual funds eat away at your potential return? Well, let's take a look at this example as we did a simulation if you were to start investing in a mutual fund. So what we said is, hey, if you were to invest $300 every month into a mutual fund, which comes up to $3,600 annually, we said, let's take that amount and let's apply an 8% interest of return on that. The reason I picked 8, remember, I said the S&P 500 historically has provided between 8 to 12% on a compounded annual basis. However, with the mutual fund, typically mutual funds have either a 2% or higher fee. So we applied a 2% to this example. And we're going to let this investment grow for over 15 years. So here you can see the total fees paid is $16,746. Your final investment value comes up to $88,821. Now, this is a decent amount. However, let's take a look at the ETF. Now, we ran the same simulation with the ETF. We said $300 a month. We get 8% growth in interest. However, like I showed you earlier, and this is why I said the most important thing, or one of the most important things to do when looking at ETFs, is look at your expense ratio to see how much they will be charging you. The annual fee here will be 0.1% compared to the 2% of the mutual fund. And we're letting that grow for 15 years. So what do we have? We have total fees paid, $915, a final investment value of $104,000. Now, as we can see, by going the ETF route, you are able to save yourself $1,000 every year. So hear this. I want all you to like, comment, and subscribe if you are somebody who wants to save $1,000 every year just by going the ETF route. Now, obviously, if you're putting more, let's say this was $500 a month that you're investing or $1,000 a month that you're investing, now you'll be losing way more in value just because you decided to stick with the mutual fund. Now, I don't want to say, hey, don't ever consider a mutual fund. You may be the person who just, honestly, your comfort level, you are okay with spending that 2% to the institutions. And you know what? Kudos to you. Me, I'm not that person. I'm somebody who works really hard. I go to work, I grind, and I want to make sure that my investments bring back the most value that it could possibly can. And this is what I'm really trying to bring out there to the world.